time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
Yes, this Your Stock, Our Take actually came in from Trevor via email, and he asked us for us to choose between one or the other to review between Tamarack Valley Energy versus Pine Cliff Energy. But I thought that I would just go ahead and compare the two businesses. Now, Pine Cliff is the orange line here, and Tamarack Valley is the blue line. But first, let's look at Tamarack. So Tamarack Valley Energy Limited, TVE, on the TSX, currently trading at a price of about $3.64, just over a $2 billion market cap and a forward dividend yield of 4.1%. Now, Tamarack is an oil and gas exploration and production company focused primarily on Charlie Lake, Clearwater, Cardium, and enhanced oil recovery plays in Alberta, with production at about 50% heavy oil, 25% light oil, and gas and NGLs making up about 25%. And the company initiated a dividend in January of 2022. So looking at Tamarack's financials, which were reported in March of 2023, and this is for Q4 of 2022, revenue was up 74%, primarily due to an increase in production. Adjusted funds flow per share was up 16%, also because of production increases. EPS was down 74%. The company has a 12 trailing month payout ratio of about 15%, net debt of $1.356 billion, and a net debt to adjusted fund flow multiple of about 1.8 times. Now, moving on to Pine Cliff here. So Pine Cliff Energy Limited, PNE, on the TSX, currently trades at a price of around $1.30, has about a $456 million market cap, and a forward dividend yield of 10%. And Pine Cliff is engaged in the acquisition, exploration, development, and production of nat gas and oil in the Western Canadian Sedimentary Basin. And the company primarily produces nat gas, which is expected to be about 85% of production in 2023. And the company initiated a dividend in June of 2022, so just a few months after Tamarack initiated its own dividend. Now, looking at Pine Cliff's financials, which were reported in May 2nd of 2023. So revenue for Q1 of 2023 was actually down 18%, primarily due to a reduction in the price of nat gas. Adjusted funds flow per share and EPS were down 33% and 80% respectively. The company has a 12 trailing month payout ratio of about 36%. And they have a nice balance sheet with about net cash of $58.1 million. Now, this wouldn't be a Keystone video if we didn't warn listeners of the risk that volatile commodity prices can bring to a company. And if we look at this chart, we can see that both of these companies are highly correlated to the price of energy, with Pine Cliff as the orange line, Tamarack Valley as the dark blue line, and the light blue is West Texas crude oil futures. So you can see they are highly correlated to energy prices. So keep that in mind if you do want to invest in this company or these companies. So I think this is difficult to compare the two because they really aren't, direct comparables, because one's focus is primarily nat gas, where the other one is, more actual crude. But I thought that I would highlight both of them side by side anyways. So looking at growth going into the 2023 fiscal year, Tamarack is guiding toward better production growth, whereas Pine Cliff expects annual average production to remain flat or even come in slightly lower for 2022. So my thought here is that if energy prices do continue to come down, at least Tamarack may still post revenue and maybe even earnings growth for the year, depending on how the increase in production and change in energy prices balance out. Now, Pine Cliff does pay a better dividend yield of 10%, albeit at the expense of a higher payout ratio. And Pine Cliff trades at a lower valuation of 2.6 times enterprise value to AFFO. But this is, essentially expected given its smaller size and less growth anticipated into 2023. Looking at the balance sheet, Pine Cliff's is superior with a net cash position compared to Tamarack's net debt position, but I don't think that Tamarack's balance sheet is by any means over-levered, but it is something to monitor, especially if we see, energy prices come down. Ultimately, in my opinion, it is really a toss-up between the two and might come down to a growth versus dividend income investment case. As if I was looking for income, I would likely go with Pinecliff due to the higher yield and cash-rich balance sheet, but it just has limited production growth anticipated into 2023, which could be a bit of a concern if we continue to see energy prices come down. But yeah, that is my conclusion. And now I'm going to put these guys on the spot. Which one would you guys go with, or neither?
Well, I actually had I had a conversation with the CEO of Pinecliff around the time that we did the dividend All Star report. So I did manage to take a good look at Pinecliff Energy, and ultimately we do have another company, a royalty streamer in the energy space to get natural gas and oil exposure. A few things that I did really like about Pinecliff is one, that net cash balance sheet. Balance sheet's extremely important with these commodity companies because we don't know where the price is going to go. So if you're looking at the earnings, the cash flow on a trailing basis, that may not have any resemblance at all to what the cash flow is over the next year. So the security of that cash rich balance sheet would be important to me. If you look historically at Pinecliff Energy, they produce consistent cash flow every year, even when commodity prices were at rock bottom levels about 5 years ago. Now, it wasn't much cash flow back then, but it was positive cash flow. And I don't know what the management ownership is of Tamarack, but I believe I remember that Pinecliff had a pretty good position that was owned by the CEO and other board members. So there was good alignment there. But I mean, in terms of, which one would I buy? I'm not saying I would buy Pinecliff. I don't know enough about Tamarack to really make the comparison, but there were a few things I did like about Pinecliff. Again, it just comes down to that commodity price sensitivity is the major factor. And natural gas prices have substantial. I mean, they really fell off a cliff compared to the highs last year.
Yeah,
They fell off a pine cliff. That's what they did.
Yeah.
Oh, I would say that generally speaking, I would not invest in an oil and gas producer, like a producer, not a royalty company, but a producer for the dividend. I've just watched for 20 plus years, cuts, reinstatements, cuts. It's not something that I would say that should be part of a long-term plan is to continue to bank on a dividend from a company or businesses that are based on the price of an underlying commodity. And if the management team in an upcycle gets too optimistic, runs into a debt situation, and then the commodity falls off, which it eventually does at some point, it's up and down, then they can get into a situation where the cash flow is really squeezed and they either have to cut, or there's even worse scenarios that can happen with those type of businesses. So I just wouldn't count on a company like this for a dividend, even if you see that juicy 10% yield right now. I'm not saying Pinecliff specifically. I'm talking about the industry in general. Counting on a dividend is typically or historically not a good thing.
No, I think that's a great point. And even just looking, as like I did say, both companies ended up initiating a dividend in early 2022 while we were kind of seeing, we had trailing or higher energy prices, so both are making the decision, okay, we're seeing better profits here because of energy prices. Well, what happens if we do see the reverse, energy prices come down, there is that.
And of course, it could go the other way and everything could be all blue sky and it could do tremendously well. But again, it is all really dependent upon the underlying commodity. So